there's too much that goes into the fiscal spending pie in order to actually cut spending. And nobody worth their salt in Congress who wants to get reelected will vote to either cut spending or raise taxes. We have Social Security, we have Medicare, we have military spending. No congressperson or senator would ever try to put forward a measure, a bill, whatever, a proposal to cut spending or to reduce taxes, because that would mean that either your Medicare, your pension, all these things you've been paying for, that gets cut, or you have to pay more, and nobody gets reelected off of that, certainly. And so, a return to austerity is not going to happen at all. And so that means the fiscal train is, slowly moving. It continues to derail and move off the tracks. And we're on pace right now where we're adding roughly $1 trillion in debt, like every 90 days. I think I said 30, I meant 90. The debt right now is 34, $35 trillion. I can't even remember. And the interest expense crossed $1 trillion in Q4 for the first time ever. The annual interest expense, wow. $1 trillion. 2 years ago, it was sub 400 billion, I believe. And so we're really in a point where the Fed, having raised rates to where it is, and this is kind of the monetary side of things, it's causing these interest payments on the United States Treasury's outstanding debt to be so much higher. It has caused this huge balloon from 300 some odd billion dollars each year, which still is a hugely exorbitant sum of money to be paying in just interest on your debt. But also it's caused it to move from that to over $1 trillion. And in doing so, it kind of means, okay, the United States is in a position where we already are issuing such an obscene amount of debt. Now the interest on that debt is over $1 trillion. How are we going to pay for it? Well, the Fed has to start monetizing it. The Fed has to step back in to the U.S. Treasury market and begin buying treasuries once again, either directly from the Fed, which they already do. It doesn't have any impact on yields per se, but the Fed already plays an active role in Treasury market liquidity via something called an add-on, which is something at the end of an auction, Treasury auctions. Prior to the auction, they pledge to buy a certain amount of U.S. Treasuries. And so the Fed already supports the Treasury market in some way, but right now, buyers are more interested in high beta risk assets. They're more interested in things like Bitcoin, things like trade, like high beta risk assets. They're more interested in the stock market, in NVIDIA. And the appetite for U.S. Treasuries is always there. People need these things on their balance sheet. But the reality is right now, given how risk is performing, the appetite certainly isn't there for the heavy issuance schedule of U.S. Treasuries. And the issuance schedule of U.S. Treasuries is going to pick up even more as we continue moving throughout the months in 2024. And so higher issuance of these treasuries, the need for the United States to fund itself, otherwise the government shuts down. I'd love for that to happen, God forbid. But for a prolonged period, it doesn't happen very often. It's not like they're going to fix this problem by cutting spending or raising taxes. And so the fiscal deficit is just going to continue getting wider and wider and wider. The amount that we spend going to be much greater than the amount that we're actually producing. And so as a function of that, the Fed is going to need to take an increased role in the U.S. Treasury market. That's my view. They're going to need to ramp up their buying, buy actively from the U.S. Treasury, even maybe buy actively from banks, which means that, frankly, the risk-taking party is only going to continue.